I've heard from a number of people that they're happy to hear what I don't like at the moment, whether it's urban real estate in Canada or stocks or whatever, but they wonder whether I'm just a perpetual doomsayer and whether I dislike everything and I'm a perma-bear, or whether there are things I actually like. And it's a reasonable question because I've spent most of my time on this channel talking about stuff I don't like. And the reason I've done that is because I think the rule "do not lose capital" is the 10 most important rules that any investor should live by. Just think about the math. If you lose 50% of your capital in year one, for example, you have to make back 100% in the next year or however long it takes you just to get back to even, just to get back to break even, and you've lost all that time in the meantime of compounding. Do not lose capital is critically important, and that's why I've focused on it. But today I want to talk a little bit about the things I like, and more importantly, the process I use to find things that I like. I want to paint the background a little bit just to give us some sense of context. Investors are being sort of manipulated or forced to buy higher yielding, more risky assets in order to extract as much yield as possible. That's why we're finding markets rising to what many would argue are unsustainable levels. Don't despair though, because I think it is still possible to invest well in any market, even in expensive markets. And that includes expensive real estate markets. I mean, it is still possible to find value. It just becomes more and more difficult to hunt for it and more difficult to find it. And so that's what I'm going to be talking about today. The process that's allowed me to find wonderful investments in things like Myriad Genetics, Vera Bradley, Western Refining, about 6 or 7 others. When people talk about markets of any kind, you might have heard the phrase correcting. What that typically means is that an asset that's become too expensive falls in price, and that's a sort of correction. But things don't only correct to the downside, they also correct to the upside. When things become very inexpensive relative to their fundamental cash flow generating abilities, eventually the market picks up on that relative cheapness, and the price comes back up. In order to buy something that's cheap, there has to be what's called a bit of hair on it. It has to be almost a bad news story, or there has to be a reason why many people would say to you, I wouldn't do that if I were you. It's an immutable law of finance, just like in an immutable law of biology. You can't get away with eating only Cinnabons and chocolate cake and be the picture of health, though I have tried. The national stock markets of Greece and Ireland, for example, have been in the news, and not in a good way, in the last couple of years, but their stock markets did really well in 2013 because the market overdid it on the downside and they corrected to the upside. So when it comes to investing, you need to be able to plug your nose a little bit and buy things that might be a little bit on the scary side or might make you uncomfortable. And if you can't do that, maybe stock investing just isn't for you, and you should stay away from it at least until bond prices come to reasonable levels, or you can get better interest on GICs and so on. Okay, so getting right into it, I pay for a service that is a pretty sophisticated stock screener, but I think there's a lot of free stock screeners available for people, like on Google Finance, for example, and I think Yahoo Finance still has one. The first thing that I look at is return on assets. Return on assets is basically the amount of money that a company makes based on all of the assets that it employs, including the assets that the owners of the business own, the so-called equity, plus all the assets that the company has borrowed money to acquire. So looking at the return on assets is critically important. Companies that make a lot of money on their assets are good businesses, and I typically look for a return on assets of about 15%. The next thing I look for is inexpensively priced. So I want that great combination of high return on assets, and I also want them to be inexpensively priced. I use enterprise value over earnings before interest and taxes. That's a bit more convoluted. Price earnings multiple is a good surrogate for inexpensive. You can also use price to cash flow, which I would prefer a little bit because earnings is an accounting fiction. So typically I would look for a price earnings multiple right now of under 12. So that means that relative to the price of the stock, the earnings are 1/12 of it. So if a company is making $1 a share, you should not be willing to pay more than $12 a share for it. Third, I also like to look for no debt. Companies that use a lot of debt, a lot of so-called leverage, sort of magnify the returns. When things are doing great in the economy and when things are doing really well with the business, debt magnifies those wonderful returns. But when things start to slow down in the economy and slow down in the business, debt becomes really, really punishing. Double-edged sword, sword of Damocles in that sense. A company that takes on a lot of debt when things go south starts to find it more and more difficult, and they have to use more and more of their cash to service that debt. The wheels just fall off the wagon at that point. So it's better to buy companies that have low or no debt, in my opinion. Next, I want to look at a company that isn't issuing new shares. That leads to a phenomenon called dilution, and dilution is not good for shareholders. Let's imagine you have a blueberry pie, and you have 5 people who are sitting around sharing equally in that blueberry pie. Add 4 more people to the party, and now they all have to share equally in the same economic blueberry pie, get a smaller and smaller slice. That's what happens when a company issues more shares. Each individual share represents a smaller and smaller part of the business. So you want to avoid companies that are in the process of issuing more and more shares, because that leads to dilution, and dilution is bad. Now, I'm sometimes asked about the opposite of dilution. Is it a good idea for a company, instead of issuing shares, to go out into the market and buy its own shares back and retire them into its treasury account? The answer to that question is it depends. If the shares are inexpensively priced, then it's a great idea for the company to buy them back, because they're buying those shares back at a bargain, and buying stuff at a bargain is the basis of all good investing. If the company buys back its own shares, though, at a price that's very high relative to the future cash flow generating ability of the business, that's actually not such a great thing. The company could probably be doing smarter things with its money than buying back its own expensively priced shares. I will say that if you're using a screen where you look at high return on assets companies that are inexpensively priced, if that subset of the market is buying back its shares, I can say in general that's probably a good thing. And nice to have, but not necessarily a need to have, is a company that has a good dividend yield. A lot of people talk about how wonderful dividends are. Dividends are good from my perspective because they send a signal to the market, and that signal is we, the company, have enough free cash that we're generating from our underlying business that we can make all the capital budgeting expenditures we need to make, maintain our assets, grow the business if we need to grow the business and invest in that. And at the same time, we have enough free cash that we can give some money back to the owners of the business, the shareholders. You think also about the history of dividends. Think about the Dow Jones Industrial Average. It was started in 1896 at a value of about 41. By 1998, it had reached a value of about 9,800, which is a good rate of return over that 102-year period. Had you included the dividends, it wouldn't have gone from 41 to a little over 9,800. It would go from 41 to a little over 652,000. A caveat about dividends: there's lots of examples right now of companies that pay more dividends than they actually generate in free cash flow, and they do that in order to attract investors. There's a school bus manufacturer at the moment that does that. You want to avoid companies that pay way too much in dividends. And so that's why I say dividends are a nice to have, but not a need to have. You need to be able to generate or build a pretty good BS detector. People are perennially overly optimistic, hopeful. Analysts are no different than anyone else, and company executives have every incentive in the world to pump up the value of their business. When people talk about a company, it's a good idea to kind of discount what they're saying. Everyone's got an agenda, and it's not necessarily in your best interest to listen to them. Company that I mentioned, the school bus manufacturer, that spins off more cash in dividends than it actually generates in its underlying business. So what it's doing, it's actually going to the marketplace, selling more shares, doing that dilution thing, which is terrible, using that cash to pay dividends to its investors, and funnily enough, paying more dividends to the management special class shareholders. That's one example of many that I've uncovered. Okay, so that about does her, wraps her all up. Just to sum up, what you want to do is you want to go to an inexpensive or a free stock screening service and look for companies that have a high return on assets of at least 15% in my view, no debt, are inexpensively priced, aren't diluting. If you find a company that meets that criteria, my advice is at the moment, because markets in general are relatively overpriced, the best way to access that is by using call options, to not actually buy the stock itself, but to buy a call on that stock. So if the stocks go up and do well, you do really well. And if the stocks go down, your downside is limited because you're not risking as much capital, so you're limiting your downside and you're keeping most of the upside. If you have $100,000, for example, you don't necessarily want to put $100,000 into this current market. Instead, buy $5,000 of options on this market, so represent the $100,000 investment with $5,000 of options, keep the $95,000 just in cash or in short-term bonds to keep your powder dry and to make sure you're not going to get washed out to sea, not if, but when this market drops. We'll be talking about that in future videos, so I hope you stay tuned for those. If you're interested in reading about my investment philosophy rather than just watching these videos, feel free to access my book. The link is below, and there's also a coupon code that allows you to download it free of charge for the first month. So people who come to this site and look at these videos have access to the book free of charge, obviously. And I think that's on for the first 30 days at Smashwords. Basically, it's the 16-hour investing book that I wrote between Bangkok and Toronto via Cairo. So I spent 16 of the 41 hours it took to complete that journey writing a newbie's investment book. Basically, it's what I think, in a nutshell, most new investors need to know to help them get started in achieving success in financial markets. It's about things like how to deal with an investment advisor, how basically not to be preyed upon by an investment advisor, how to overcome challenges with the market itself, and how to overcome some of our own inherent biases that sometimes get us into so much trouble. I hope you enjoy the book. For those of you who read it, I look very much forward to feedback on the thing, because any feedback I get, any constructive criticism, is going to inform future content that I make. Thank you in advance for any feedback, and I look forward to speaking to you soon.